Let's talk about the markets and the economy in light of Friday's better than expected or worse than expected job numbers, depending on your perspective. Joining us now. It's so messed up, Komal Sri-Kumar, president of Sri-Kumar Global Strategies. We're calling them better than expected. That's why the market's down 300, because they were better than expected. That's warped. What do you think? Is the Fed looking at that? And does this mean that inflation persists when you have strong jobs, Sri? Should the Fed really be worried because of it? And will they act?
You had a great discussion with Andrew and Becky earlier this hour, and I think the concerns are well placed. You're saying, why shouldn't I have more jobs? What's wrong about it? But it's the rate of change, how fast the jobs are coming through. And yes, you are still not very much reached relative to the pre-pandemic level. But if you are going to do that over 2 or 3 months, you're going to cause inflation. Second, look at the other characteristics of the labor market. The labor market participation rate is still relatively low. Second, you have 1.9 jobs for every unemployed worker, whereas in November we had 1.7 jobs available. Powell has said repeatedly he needs to lower the ratio, not to raise it. So what the market is reacting to today that it was sanguine about last week, Joe, is the fact that things are going opposite of what the chairman has wanted. And what is he going to do about it? What is he going to do tomorrow? What's he going to say at the Economic Club of Washington, D.C. when he speaks midday? Those are all very important issues still for me.
Why have you thought that they perhaps would have feet of clay? You thought 4% might be the high. You thought that they were going to probably fold too early on the Volcker imitation. You thought that they would not have the resolve to go to 5 or 5.5. You think now maybe they will, Sri?
I thought last week that Powell would not have the resolve to go up to the 5% or higher level on the federal funds rate. Today, I don't know if he's going to change, but if he doesn't change, by tomorrow, and if he gives the same dovish message tomorrow as he did last Wednesday, when he spoke about the disinflationary phase starting out, when he kept repeating that the market rally does not affect the Fed's thinking, then we are going to have the market rally again for a while, and then you come up with the reckoning later on. The question is a matter of timing. Joe, you cannot avoid the Arthur Burns moment just by pretending to be somebody else. You have to play that role, and we are going to see tomorrow whether he's going to change his message or he's not going to change it. If he does not change the message, he's going to again cause more speculation in markets, eventually increasing the danger of a crash.
So you've changed. Then you have you definitely are in a different place than you were last week. So you thought that was like pivot light last week with Powell. You thought that he was dovish because he's been talking tough.
Yes, he was talking tough before. The Fed minutes, which were released January 4th, were very tough. The Fed minutes said rates are going to keep increasing throughout the year. There is going to be no cut in rates. Then you find the chairman telling us that the disinflationary process has begun and financial conditions have not eased in January. That was an important statement. We had a big rally in equities. We had a rally in bonds. And the chairman tells you it is a rally is not a rally. So, yes, he was dovish.